Tired of hearing financial terms were not disclosed? I asked Ravi Ramharak about buying MSPs. He's heading up MSP Corp. This is a bonus episode of The Business of Tech. I'm joined again by Ravi Ramharak. Ravi, you're my first return guest, so thanks for joining me again.
Thanks for having me again, Dave.
So this time we're going to talk a little different. This time we want to talk about some of your recent announcements because you're obviously with MSP Corp and you guys have put together a investment group which is focusing on bringing together MSPs into a roll-up investment organization to make a larger MSP, right? You're backed now. You've had a recent $35 million capital transaction led by BDC Capital's Growth Equity Partners and did two recent acquisitions of some Canadian MSPs. So that's what I wanted to talk about today. Let's start with your kind of basic premise. In the press release around this, you said your pitch is a simple one. You're private operators buying private operators. Tell me a little bit more about what the strategy is to build this org.
Yeah, great question. So I think that you look at every strategy right now, and they're kind of all the exact same. Buy 5 or 10 MSPs, merge them into one platform in an area, make that the super MSP, and then go from there. And then exit to somebody else and, flip the investment. I think when you look at the industry as a whole, and I've been around since I was 18 years old. I'm 35 now. And the same clients have been employing me, believe it or not, that entire time. And so I look and I'm like, why are we selling to who? Like, we can just buy, we can build, and we can hold. And we can have 30, 40 MSPs in a large group together, and where we add value, and where we're working to add value is on the shared services. So what we first had to do was buy the MSP. So we bought 8 MSPs. They're all kind of ranging between the 5 to 25 person range. And what we did is we took a look back over the last 6 months and said, okay, where can we add value? Where are the shared services in accounting, legal, buying power, Microsoft CSP, cybersecurity, backup, hosting, telecom, the kind of 8 core areas. And then we're working now to apply those to all of the groups so that the MSPs not only increase their organic growth through shared services that they're able to additionally sell their clients, they also have more skill set internally that they don't have to hire externally for. Like, a 10-man MSP or 20-man MSP, even 30, to have cybersecurity people is very expensive, and they're not going to be that busy, let's just face it, they're not. So having a centralized NOC, for example, and being able to resell those services down or offer that value. And where I think our model is different is that we keep the brand autonomous from us. So the staff know about the transaction, the owners obviously know about the transaction, all the vendors know about the transaction, but the client never really knows. Because I believe that MSPs are a regional business. I've always said this since day one. You got the CGI and IBMs, all the big guys. They're doing national work, but really the MSP client is a regional company.
So I'll buy this premise for increasing the value on anybody who gets acquired, right? I get that. Yeah. I get their value there. And I get the value in this model for MSP Corp, this expanding MSP itself. Yeah. So what I need to understand to baseline this is tell me how your investors plan to make money, because if you're just going to grow this bigger MSP, at some point they want a return on the money they put in. How do you plan on delivering that?
That is a great question. Okay, so number one, 95% of investors won't like us because we're a long-term play. The way I look at us is like, for example, BDC. We pick them and work with them because they have a long 5-10 year horizon. They're not in this for a 1-year return. So for us, as we build up our revenue platform, you could potentially see us exiting to, probably going public at some point. That's the most logical answer, I would think. Or just buy and hold. I mean, you've got great cash flow in these businesses. These are not SaaS-based companies, burning through revenue every month. They all generate 20% EBITDA margins. I think from there alone, you have a great return. And I think when we pick our investors, especially the current one we're working with, it's what is your strategy in your fund? If it's to come in and in 3 years, pick this up and go, it's not the right platform for us. If you have a long-term approach, like for example, look at the recent deal by Fully Managed in Telecom. It's not really announced, but you've heard about it, I've heard about it. Look at that transaction. For TELUS, that makes sense. TELUS is going to be here for a long time. To get into the MSP space makes sense for them because they have the platform to not only cross-sell telecom services. So I think for us, there's lots of potential exit strategies through either public markets, through a telecom player, through a synergistic value player, where they would look at our market share and say, wow, if I have access to 50,000 small to medium businesses, what can I do with that on a larger platform? I don't think we need to have a general private equity exit.
Okay, so I get that. Now let me push back a little bit because there's a big difference between a 5-year exit and a 10-year exit. How comfortable are the investor group that you're working with looking at a 10-year return on investment?
I would say the way we pitch it right now is a 5-year return on investment. And then we could look at a cumulative fund to recap and keep that going. I think almost every investor's max is about 5 years.
Okay.
So right now, we're really focused on the 5-year approach, get to the 5-year mark, and then reevaluate our position at that point and see which investors want to stay in long term. Again, this is this is kind of like you're almost like buying like a janitor or a plumbing or like an HVAC business. They can just keep going for a very long time. So I think for right now, it's just 5-year approach.
Okay.
Let's get scale of economics that makes sense. And then let's look at the right investment thesis at that point. What's the next step?
Okay. I'm pushing because I keep telling my listeners, follow the financial investments to understand the motivations. So I wanted to get some clarification in there. So let's make this practical for MSPs themselves who are thinking about the valuation of their business. Tell me about how you're valuing the businesses you're buying.
Okay, so one of the big things about us is that because we're an accretive buyer and that we're very niche in the MSP space, I look at 3 major things, okay? Recurring revenue, above 50%, ideally contracted if possible, like 1, 2, 3, auto renew. Management that's either like the owner himself or she-self, whoever it is in place but not managing the business. And then in an ideal world for our acquisitions today, the ownership is in a senior position, but they're not really doing a lot. They mostly are like there to pay homage to the brand, but they've got their business kind of running autonomously. That adds a lot of value. And I think third and most important one is they have diverse revenue stream. Like I don't want to see 90% hardware or 90% project. I'd like to see, 50%, 60% managed services, 20% project, 10% cyber, 10% hardware, whatever the mix is, some diverse revenue stream. Those will be the 3 biggest ones for me.
Okay. Now I'm going to push a little bit again here too, because look, the one thing I'm pushing back on is all the time you read about these deals and they all end with the line, financial terms were not disclosed. So no one has the ability to actually understand anything about the deal. Yes. I'm not going to call you. I know you've done 2 deals recently, and I'm not asking you to specifically tell me exactly how that works, but be a little more specific about how is the deal structured in a way that that a potential owner would understand, okay, I've got a range of how much my business is worth.
Yeah, sure. You know what? I'll give you the exact number for us.
Okay, great.
And I think we're pretty industry standard, so your reader take it with a grain of salt. If you have EBITDA, so let's say adjusted EBITDA, which your accountant can help you do, of around 400,000 to 600,000 Canadian dollars.
Okay.
I'll say you're going to trade in roughly the 5 to 6.5 EBITDA range. You're probably going to get 3 to 4x upfront in cash, and then you're going to get the rest probably in some sort of earn-out structure, 1 or 2 years, with some sort of EBITDA target, so that the new buyer has you kind of transition yourself out. Or if you're staying longer term, you might keep some, a longer hurdle with a higher payment for yourself. So I would say again, that's the multiple for me, I would see kind of going forward. If you're 600 EBITDA to $1 million EBITDA, you're going to trade between 6.5 to 8.5 EBITDA margin, depending on how good your revenue is. And that's going to come down to those 3 factors I mentioned earlier when you asked me.
Okay.
And then you're trading above $1 million in EBITDA. Well, I mean, look, you can get anywhere from, I've seen 5x deals because the clients were really bad and the business poorly run, to 12x deals. So kind of all over the place.
Okay, so you've given some gating criteria. Is your intention with the ideal deal to to retain leadership or let them exit after a payout starts? What's your intention?
Ideal world, they stay on board. Here's what I'll tell you. What I found with 99% of our owners, the minute they get that check, the stress is gone. Not every owner. We have some owners that are 65 that are retiring, like they're on their way out. But for the majority of younger guys in their 30s to 50s, I mean, look, including myself, I don't have a lot of other skills. I've been doing the IT business for the last half my life. So it's not like I can go start a janitorial company tomorrow or go open up a restaurant. I don't know how to do that. So for me, like, I think a lot of guys, when you take the stress of the sale away, they get to really do what they love again. And most guys are staying on board long term.
Gotcha.
We had one where he was adamant of leaving. And after 2 years together, he just signed another 1-year contract. And it becomes a very, like, I don't know, the love for the industry comes back to what it originally was.
Okay, so what's the smallest kind of entry level that you'd consider from an acquisition perspective?
I don't think, yeah. Okay, so when we first started, it was very different. We're kind of in the 300,000 to 400,000 EBITDA margins. Or EBITDA range. I would say now today, and this is my recommendation for anybody: don't sell till you're over 500,000, because a lot of the systems in place you need, you haven't done them yet. And so what happens is the buyer is going to take you for a big coupon. Look, we want to pay top dollar for a business, and I'm even nurturing 8 MSPs right now over the last 2 years to build a better business. So I have like my own kind of private like nurture where I'm helping them every year kind of look at their financials, look at their books, and kind of help them mature their business. We're happy to pay them top dollar, but a lot of times 300,000 to 400,000 EBITDA, you're going to get really chomped on value.
Okay. Now, give me the biggest warning sign that you'll see from when you start looking and doing due diligence on somebody that beyond that once they've checked the check boxes for your minimum numbers, what's the next thing that would instantly say like, oh yeah, this is not the right deal for us?
Client concentration.
Okay. Elaborate.
Yeah. If you have a client that takes up 20, 30% of your revenue, your value drops by half right away for everybody.
Okay, got it.
Unless, because there's so much on, change of control clause post-close, you don't know what that client's going to do. So I would say that's the number one thing that kills every deal I've looked at. When we've gone through the first stages, we haven't gone through the client list yet. And when we do, we're like, hold on a second here. There's just one client that's got a really big number for you. So that's number one. Number two that's going to really kill you post-close is on finding out the areas that your clients are in. If you're in retail or hospitality, you got to start pivoting those clients out and like start to get into the more small business, medium business, healthcare, and that kind of stuff.
Gotcha.
I think those are the two big things that kill you.
Okay. So you've been doing, all your deals so far have been Canadian, right?
Yes, correct.
And for 2022, you're looking to break into the U.S. market?
By mid to late 2022, we'll be in the U.S. market.
Okay. How many deals do you think you're going to try and do?
Oh, Dave, tough question. I can't tell you that. I would say this year, I think we'd like to do 5-10 deals.
Okay.
I think 2023 will be wrapping up a lot. Like, our vision internally, just so you know, is, we want 50 deals in 50 states. It sounds crazy, but that's the model we want. Well, we've done that in Canada, and now we want to do that in the US.
Gotcha. Well, Ravi, let's give listeners a last little tactical bit. If somebody is thinking about this, what would you advise them to do first to get ready to be serious about an acquisition discussion?
Okay. I would say, first of all, my email is always open. If you're 3 years ahead of where you need to be, send me an email. Send me a link and ask me. Here's why. I was an operator first and foremost. Today I'm a buyer, but for 17 years I was an operator. I understand the difference between selling your business for 10x and getting 3x. And I can tell you, a 5-minute phone call will save you a lot of time. So that's my personal suggestion. Outside of that, I think companies like Service Leadership, they publish some great data. If you're really wanting to be a top tier MSP, it's a little bit expensive if you're starting off. But if you join Service Leadership and really use their metrics, you'll probably build a very good business long term that investors will like. So if you're too shy to talk to me, too shy to talk to anybody on our team, or even just, there's great guys like Evergreen out there you can talk to. There's mature companies like F12 you can talk to. Reach out to your peers. All of us essentially started in the MSP business. So, I think we'll all have advice to give you. And I don't feel like anybody's too predatory. I've talked to every big buyer in the space over the last 2 years, and even within us, we share information. So I think it's a very non-predatory space.
Thanks for listening to this bonus episode of The Business of Tech. If you like it, hit the like button and hit that red subscribe button. It really does make a difference, and I appreciate you taking the time to listen to what I'm doing. You want to discuss more? Want to find out more about the interview? Go ahead and put something in the comments. I read them all, and I look forward to the ongoing discussion. If you want to get content like this every single day, the 5-minute Business of Tech podcast is available wherever fine podcasts are found. Go to businessof.tech, click the blue subscribe button. You can find us on Apple Podcasts, Google Podcasts, Spotify, or wherever you listen to podcasts. Additionally, if you want to help me with the content that I create, you can support me directly. Go to patreon.com/MSP Radio and click the button there. You choose what the content is worth and get access to these interviews and discussion episodes early. They come out for my Patreons, and Patreons drive the discussion and ask questions directly. Looking forward to ongoing conversations, and thanks for watching.